The 2024 presidential election, it is a key focus for investors, with a Trump versus Biden rematch seeming more and more likely. But what does either outcome signal for the global markets? We want to bring in Peter Oppenheimer. He's Goldman Sachs global equity strategist and head of macro research in Europe. And we're also joined by Yahoo Finance's executive editor, Brian Sizey. Great to have both of you. Let's talk about what exactly this election could potentially mean here for the markets, Peter. And I think more broadly speaking, is Trump or Biden, is one candidate viewed as a better alternative here for stocks?
Well, I think the first thing, and thank you for having me, is to say that, of course, we have a lot of elections this year around the globe, the most important one being the US. And one thing that's interesting, despite the potential volatility that could bring, is that implied volatility in the equity market is really very low at the moment, to the point that you mentioned in your earlier remarks. So I do think that we are likely to see more volatility in equity markets as we move through the year and the elections, and particularly in the US, become more relevant. And obviously, the US election will have a big impact on the global economy, in particular because of its impact on possible trade policy. The potential Trump administration bringing blanket tariffs across the board of products bought into the US would have a much bigger negative impact outside of the US, of course, than in the US itself. And I think that will be the major focus of investors in other markets this year.
Peter, Brian here. We've been talking to a lot of folks that are cautioning against, another potential Trump presidency maybe not being as good as investors as the first presidency was. Of course, you had those tax cuts under President Trump. Do you think a second presidency would be more challenging for investors, just given some of the things you outlined?
Well, I think, Brian, you raise a very good point. I mean, one of the reasons why the equity market, as you recall, rallied so much after that last election was the expansion of tax cuts. And there was more fiscal room to do that then than is the case now, given that the budget deficit is so much bigger and US government debt is much higher. So there's less room, really, to repeat the scale of the tax cuts that boosted the stock market so much last time. That being said, it's unlikely that you'll get fiscal contraction under either outcome, and maybe more focus on regionalization and building up manufacturing again in the US, which might be supportive for US companies, but again, less so for companies trying to sell into the US market.
Peter, would you say is the current status of kind of international trade, where the U.S. needs in those next 4 years of any term to position itself? And of the two candidates, where do you see actual movement forward?
Well, I think I don't think there's a very big difference on this regard with either candidates. I think the general pattern here is one where the globalized process of world trade that was really the dominant driver in the last 15 or 20 years is beginning to reverse to some degree. And this is reflecting the rise in geopolitical tensions, also the realization after the pandemic that complex globalized supply chains may be less reliable moving forwards. And in addition to that, things like decarbonization is forcing more focus on regional or domestic production. So I think under either circumstances, it's likely that we're moving into an environment where there's less expansion of world trade. And therefore, it really matters a lot what the domestic growth rates are in these different parts of the world.
And Peter, against this backdrop, you're out with a new book. Congrats on that. I believe that is your second book. Congrats on that one. And to me, the vibe, just reading it, Are There Any Happy Returns is in fact the name of that book. The vibe for me is that investors should almost get outside of perhaps this focus on politics and maybe interest rates and really lock in on what you're calling super cycles. So what super cycle do you see emerging over the next decade, and how do investors make money on it?
Well, thank you for emphasizing the book. Yes, what it really is saying is that investors should perhaps focus less on what's urgent, like the near-term prospects of inflation or interest rates. And that really is the cycle, and indeed is moving in a positive direction as we expect inflation to come down and interest rates to follow this year. and really focus more on the important longer-term structural issues which create these super cycles. And there are some challenges, I think, that we have to look forward to. One of them we've just been discussing: less globalization, more regionalization, more repetition of supply chains. That means higher costs and less margins for businesses. We're also in an environment where we're not likely to see interest rates trending downwards consistently over the next few years, as we've seen in the last decade or two. And that means probably a higher cost of capital and lower returns. But at the same time, there's some very exciting developments to focus on as well. The combination of the impact of things like AI on the one hand, which ultimately could boost productivity, and at the same time, the significant changes that are likely to emerge as we move towards a more decarbonized, greener energy policy. And that's going to create a lot more jobs through more investment in clean technologies and clean energy.
Yeah, Peter, digging a little bit deeper here into the technology and AI point that you were just discussing, I think more specifically, how do you see that impacting returns here going forward? Maybe not so much in the next 2 to 3 years, but more so on a longer term timeline. And when it comes to what investors should do then to best prep their portfolios or position them for that, what would your advice be that investors should consider today?
Well, I think both of these factors are going to be very important drivers of the global economy in the next decade. Insofar as AI is concerned, on the negative side, you've got the prospect of some job displacement. I mean, after all, AI, ultimately, if it's going to boost productivity, will do so by taking some jobs. But the positives are that I think it will boost productivity. And you'll start to see companies outside of the technology sector starting to leverage and employ these technologies to become more efficient and create stronger growth. There are many sectors where this could have a positive impact. Healthcare is a very good example, where large data analysis can help to speed up drug discovery. In terms of decarbonization, the cost here, or the near-term constraints, are really how much it's going to cost to reconfigure our economies and to build the necessary renewable networks and infrastructure and the investment to improve environmental technology. But again, the longer term benefits will be that the marginal cost of energy will come down significantly. So I think investors should look at both of those areas as broadening out the possibilities for companies that can work towards utilizing these drivers, who can help facilitate the move towards a decarbonized economy because they're likely to see stronger long-term growth, and what companies can really utilize new technologies and things like AI to become more efficient, to create new products and services. And those are two areas that we're very focused on.
Some really valuable insights there. Peter Oppenheimer, Goldman Sachs global equity strategist and head of macro research in Europe, alongside Yahoo Finance's executive editor, Brian Sozzi. Thank you both.